Hello, welcome to TMA virtual hit session on basic protection. As the slide says, my job is to talk to you about life insurance. Please don't make it my job to tell you your family didn't have any. Very powerful statement I think needs to be considered all the time when we talk about mortgage arranging. Today's really going to be about giving you some really basic idea of what protection is, the different types available to help you for future. Starting off with protection, what is it? A provider last year, I think it was, asked or did a survey asking a number of people what their idea of protection was. The top three answers. First one was hard hat and goggles, the kind of protection against building or that type of thing. Second was contraception, and in third place was life assurance. Now, if your job is a mortgage and protection advisor and you've just spoken to your client about a mortgage and then you start talking about protection, there's a chance that of those three, they're probably more likely to relate to the third one of life assurance. But just be mindful that if you suddenly bring up protection, it might not always be exactly what you think that the client's thinking about. So it's really important just to clarify that for them. The agenda that I'm going to talk about today, this doesn't cover all of it, but today we're going to cover the knowledge. So this is very much geared at the basic side of protection, what the various bits are. Also things to consider, and this is things that we can talk to you about at a later stage, would be sales skills. We've actually got another TMA hit training session on sales skills. It's been run a couple of times already. Then recommendations. And what I mean by recommendations is that if you had 10 mortgage advisors and you gave them all a fact find, the chances are that of the 10 mortgage advisors, they'd probably come up with the one lender, one mortgage deal, or maybe a second one slightly different. But on the whole, you get a very similar reply from them all. If you gave a protection fact find to those 10 mortgage and protection advisors and asked them to come up with a protection recommendation, the chances are you'd actually come up with different recommendations. So there's much more variation involved with protection. Again, something that we can talk to you about at a later point. The process. Now, what I mean by the process is whereabouts do you put it in your sales process? How do you bring it in? How do you talk about it? What do you do to make sure that protection is talked about every time? And if you've got the knowledge and you're using some good sales skills and you know what you're going to be recommending to the client, it's really important to have a process built in that means that every time you go over what you need to do to give the client the best opportunity to talk to them about their protection needs. Lastly, technology. What I mean by technology is how to use the technology available in different formats that means that you can get the best out of what you're trying to do. Right, so as I said before, today we're going to be talking about the knowledge, and there's three areas. There's life cover, critical illness cover, and income protection cover. I'm going to take each one of these separately. So we'll start with life cover. Probably the easiest one in that this pays out if you die. So it's fairly black and white. If you're alive, generally it won't pay out. If you're dead, that's when the policy would look to pay out. Now, I'm going to go through a number of different parts of life cover as to what it would mean. So when we talk about level cover, for example, if you took out a policy that was to last, say, 20 years and you took it out for £100,000, if you took out a level policy, that means that if you made a claim at any point in that 20 years and it was to pay out, it would pay out about £100,000. You could have a decreasing policy, which means throughout the term of that policy, the amount that it pays out would actually reduce. Now, that's perfectly aligned if you have a repayment mortgage, because obviously with a repayment mortgage, you're reducing the amount of money outstanding to the lender every month, every year. So a decreasing policy would actually come down in line with the amount that you owe to the lender. It would also cover, say, a loan. So if you had a 5-year personal loan of £25,000, for example, it would come down in line with the amount that you owe through that period of time. Increasing, there are some policies available which the amount of cover actually increases, and that's really geared to set about the rising cost of inflation. So not relating to a loan, but maybe relating to having to survive if you've lost someone, the breadwinner or whatever, that your costs are going up. So it would actually increase as time goes through the term of the policy. I mentioned term before. That's literally just the length of time that you're setting the policy up for. Now, in the mortgage and protection world, generally you would set the term of the policy to coincide with the length of the mortgage. So typically policies are arranged for 25, 30 years, but you can have them set for any period of time you like. If you've got a personal loan, say for 5 years, you could set it up for 5 years. If you're setting your protection up to cover your family, so if the breadwinner was to die, then the remaining partner had a couple of children, you may want to time that or have the term of the policy to coincide with an age when you may consider that they might be no longer dependent upon their parents for income. So myself, for example, my kids are 12 and 14. If I was to die, it would be quite good for my wife to think that there was some money available to look after children until they're about, 22, 23, something like that, when they're off her hands. Sounds terrible, doesn't it? But actually then able to be looking after themselves. So the policy I might choose would be for 10 or 12 years or something like that. Okay, the next thing, joint and sole, that's how we set the policy up. So if you've arranged a mortgage for a husband and wife, let's say, for example, it might be that you set up a joint life policy. So both of the husband and the wife are both covered, because if either of them die, you want the whole mortgage paid off. So you set the policy up that if either of the husband or the wife dies, then there's a payout. If you've got a mortgage taken out in someone's sole name, a single person buying, then it would make sense that you would take the life policy out in the sole name of the person who's taken the mortgage out, which means if they were to die, the mortgage is paid off. The next one's a little bit more confusing. Joint life first or joint life second death. Now, what this is, if you have a joint life policy, obviously doesn't relate to a sole life, but if you have a joint life policy and it's mortgage related, this will be the majority of the scenarios, then you would want the policy to pay out when the first person on the joint policy were to die, so that the second person has the money. And you kind of say to yourself, well, why would I ever want it that it's paid out when the second person dies? What's the point of that? That's set up specifically for inheritance tax purposes. So I won't go into inheritance tax today, but more than happy to talk to people about it in the future. But if you have a husband and wife, when the first person dies, the inheritance liability, as it were, passes to the remaining partner. So your allowance goes across them, so there's no inheritance tax due. But when the second person dies, if they're passing their estates, everything that they own, down to their children, that's when an inheritance tax liability is due. So if you had an insurance policy that were to pay out when the second person were to die, therefore it'd give you some money to pay the inheritance tax. That means you could pass your estate down to your children and they wouldn't have to pay the inheritance tax. It would be covered by the insurance policy. Waiver of premium. So with a life policy, if someone was to have an accident or be made sick and be unable to work, the last thing you would want, and it would be typical, is that you'd start reducing some of your outgoings. And therefore, the last thing that you would want is that you've been made, you've had an illness, you can't go to work, and then suddenly you've decided, oh, I've got to cancel my insurance policy. You die, you've got no cover. So what waiver of premium does, it would actually pay the policy itself. Normally, there's a period of time when you have to wait for that to kick in, and it's often 3 months. So if you've got a life insurance policy, you've got waiver of premium attached to it, and you're unable to work due to an accident or sickness, you make a claim to the insurance company. If you're still out of work in 3 months' time, then the policy will pay itself. It's just a way of making sure that if you have a bad scenario of not being able to work, you can still have your life cover. At the beginning, I mentioned that life cover pays out if you die. Terminal illness actually goes against that, because what terminal illness is, that if you are diagnosed with something really, really serious and the doctors are saying to you, you know, you're terminally ill, you're going to be dying in, you know, they never give an exact period of time, but, you know, don't book a Christmas holiday kind of thing, then actually you can make a claim, and if the life insurance company agree with it, they'll pay out the life cover before you actually die. Now, the advantage of that is if it's you that's got the terminal illness, you can help plan what happens with the money, how to pay off all the bits that you might want to pay out. So it's just a really good way of enabling when the inevitable happens. If you have a terminal illness, there's slightly less concern because the money's already paid out. So it's helpful there. A whole of life policy, this is kind of in conflict when I mentioned term, in that a whole of life policy doesn't have a term. It will carry on for as long as you keep paying the payments. So if you are, I don't know whether it be fortunate enough to live to 135, as long as you're paying the payments, the policy will last until you're 135. there's a couple of reasons why you may want to take that out. The first is you may well use it as a funeral plan. So if you've got a policy that pays out when you die and you've set it up for, say, £10,000, you know that when you die, £10,000 is going to be paid out and the people can use that money to pay for your funeral and all the associated costs. There's no point having that termed, because if you set it up for 10 years and you live past 10 years, well, it doesn't pay out. Another reason for whole of life policy would again relate back to inheritance tax. So if you had a whole of life joint life second death, I mentioned earlier, so what you would want is that policy to carry on until the second person dies, not finish before. There's no point if it finishes before for inheritance tax purposes. So if it's a whole of life policy, would happen when the second person dies, then that would pay out, that would help pay the inheritance tax bill. The third one is just if you want a policy to go on for longer than normal. There have been times when, for whatever reason, whole of life policies have been perhaps a bit cheaper because of the market. And when you've looked at it, you've gone, blimey, I can have that policy for the same length of time as I can have one for a 30-year term. And you might take it out for that reason. That means that you're covered as long as you keep paying for it. So it can be quite handy from that point of view. Family income benefit is a life cover policy, but rather than paying out a lump sum when you die, what it does is it would be to pay out a monthly amount if you die. So if you wanted, let's take a husband and wife and 2 children, and the main breadwinner was concerned that if they were to die, the remaining spouse wouldn't have any income. If you set up a life policy and it paid out £100,000, for a lot of people, £100,000 in a lump sum when it isn't to pay off a debt is quite tricky to manage, because how much do you put aside? Where do you put it? How often do you want to take money out? That type of thing. So a family income benefit, you might turn around and say, right, well, I want it to pay out £2,000 a month until my kids are in their 20s. So you take a 10-year policy and it pays out, if you were to die, £2,000 every month until the 10th year of the policy being live. Now, that's a really, really cost-effective way of providing cover, because it is actually set up on a decreasing term assurance basis. Because if you were to die on day 1, the amount it pays out is an awful lot more than if you died in year 9. So it's actually a decreasing term policy, which makes it a cheaper form of having the protection. But from the people taking the policy out, you'd still get your £2,000 until the children are 20, whatever period of time you agreed at the beginning. I'm going to mention this just in case you come across it, but it's very, very unusual. You'll deal with it. Gift inter vivos. This is, again, inheritance tax. There's a rule that says you can give money to people, but if you were to die within a certain period of time, then there's an inheritance tax benefit on it. So let's just say I'm lucky enough to have £10 million in my bank account and I want to give my children £1 million each. If I die within the next 7 years, I'll have to pay an inheritance tax on that £1 million I've given to each of my kids. If I last longer than 7 years, there's no inheritance tax to pay. So there's nothing stopping me giving them the £1 million each, but it could be that there's a liability. So a gift inter vivos policy is specifically set up for 7 years and comes down in line with the inheritance tax amount that you make payable. So it's just a way of making sure you can give the money to your children in that scenario and there's no inheritance tax to pay. Last one on this page is relevant life. This is relevant. This is a policy that's set up for companies rather than individuals. Now, the reason we get involved in it at mortgage and protection level is if you've done a mortgage for a limited company. Now, that limited company might be a tradesman who set his business up, but he set it up as a limited company and he's now getting a mortgage. He could be a sole proprietor of the business, but he set it up as a limited company. He could actually take out a relevant life policy to protect his mortgage. So, for example, he's got £100,000 mortgage and he's taken a life policy out on the basis of the relevant life. His company would pay the premiums rather than him individually. And because of the tax laws and the way it's set out, it makes it a lot cheaper. So typically, if you want to pay something, if you buy something and it costs £50, you've had to earn more than £50 to allow for the tax to pay that. So a relevant life policy means that you can set it up against the company and then the company make the payments rather than the individual. And it can mean that it's either a cheaper way of getting insurance, or they can have the same amount of cover for less money. Right, let's move on to critical illness. Now, this pays out if you're diagnosed with a predetermined illness. Now, those predetermined illness, typically heart attack, stroke, cancer, that type of thing. Many of the features of a critical illness policy are exactly the same as a life insurance policy. So a level, for example, whether it's set up that the amount payable is the same throughout the whole policy or decreasing, typically, again, coming down in line with a mortgage. So they're exactly the same. Increasing, the same as before as well, as the policy could go up. And the term is the length of time that the policy lasts. Waiver of premium is exactly the same as I mentioned before, in that it will pay the cost of the policy if you're unable to work through accident sickness after a period of time, usually, as I said, 3 months. Total permanent disability, slightly different here, because at the beginning I say it pays out if you're diagnosed with a predetermined illness. Sometimes it's considered if you become totally permanently disabled that the policy would pay out. And what that typically could be is if you were to have a car crash, for example, and you're maimed, you're permanently disabled, but it actually doesn't mean you've had a heart attack or stroke or got cancer or anything else. It could be that the policy pays out. The way they often determine this is whether you are able to do a number or not able to do a number of daily living activities. So can you tie your shoelaces up? If you can't do, say, 3 of a predetermined list of 5, if you can't do 3 of those things, it could be a class that's permanently disabled, and therefore the policy would pay out for you. I'm now going to go on to income replacement. Where this is different is it pays out a monthly benefit if you're unable to work due to an accident or sickness. Now, the family income benefit that I mentioned earlier with the life policy, that paid out if you were to die. So the income replacement pays out a monthly benefit if you're unable to work due to an accident or sickness. Again, term, it'd be the length of time that you take the policy out. Now, there might be a couple of different terms that you link it to. Typically, as with mortgage and protection advisors on the whole, you would possibly link it to the length of time of your mortgage. So if something were to happen to you that meant you couldn't work, you haven't got an income coming in, you can have it to set up that would pay you an amount of money, which would pay your mortgage for the rest of the term. The other time you could set it to would be retirement. So you could actually set it up until you're 67. Because when your mortgage is finished, you still have costs. You've got council tax, you've got bills, you've got food. So it could be that you have it set up until you retire. Again, you can have it set up on a level basis and also on an increasing basis. Generally, with the increasing basis, it would be set up on something called RPI, which is Retail Price Index. So that's your basket of food. So a basket of food 15 years ago is probably a lot less than it is now. The idea of this was that if you were claiming, say, £2,000 a month, for example, that would go up in line with RPI, which is kind of 3-4% or whatever it is typically, kind of in line with inflation. Also, your premium is likely to go up as well. So you started off with a £15 a month premium. The premium would go up by RPI as well. So that might go up 1 or 2% each year, as well as the amount you get paid going up at the same time. Okay. Waiver of premium doesn't apply in this one because it is, as I say, an income replacement policy. Maximum amount 60 to 70%. The reason for that is that nobody likes somebody being able to earn more money when they're not able to work. So you can't claim for 100% of your salary, because if you're employed, your salary is before tax. So you then pay tax on it. That's what you take home. So it might be that the insurance company allows you to claim either 60 or 70% of your annual gross salary, and that would allow for the tax. We also have something available called budget cover. Now, at the beginning, we mentioned term, so that's the length of the time of the policy, but budget cover is slightly different because that's how long the payment to you would be made for. So you might set out a 20-year income replacement policy, but if you were to set it up on a budget cover and the event happened to you that meant you weren't able to work due to the accident or sickness, then the payment would be made to you for, say, 2 or maybe 5 years. Now, the advantage of that, the main advantage, is it's a lot cheaper. The disadvantage is that after the 2 or 5 years or whatever the term is you set out at the beginning, the cover stops. That would be suitable in an ideal world for where something happens to you and, 2, 3, 4 years down the line, you are actually able to go back to work rather than never going out to work. Strangely, you don't decide these things at any point in time. Nobody says I'm going to have something happen to me, which means I'm going to be off for a couple of years. So it is a risk, but what you're benefiting from is a much lower initial payment through the premiums. Now, here's the good bit. I thought we'd add a test to this just to see how much of it you've taken in. So what you might want to do is just grab a piece of paper and a pen. And if we just go through the questions, take a minute or so to answer them. And I've got the answers afterwards so you can see how well you've done. Don't worry, we're not going to be able to see, but hopefully it will give you just some idea as to whether it's sunk in and whether I've done a decent job of explaining what these basic levels are. If on any of it, at the end of it, you go, I don't understand it, you can get in contact with TMA and we'll be happy to go over it in a little bit more detail for you. So question 1, what product would pay out if a client were to have a heart attack? So I'll give you a few seconds between each one. Question number 2, name 2 products that pay out a monthly benefit. So that's 2 products that pay out a monthly benefit. Question number 3, what kind of life policy would be best for a repayment mortgage? So what kind of life policy would be best for a repayment mortgage? If I'm going too quick, you can always stop the presentation, put it on pause and maybe take a few more seconds to add it. Question number 4, name a kind of policy that would be suitable for inheritance tax planning or a funeral plan. Question number 5, what feature can be added to an income protection policy to combat inflation? Question number 6, a family income benefit is what kind of term policy? Question number 7, which feature means a life policy will pay out before death? Question number 8, if a client has a single life and critical illness policy and they claim on the critical illness, what happens to the policy? Question number 9, how much will a life policy pay out if the client dies 7 days after the policy finishes? And lastly, question number 10, what is the main advantage of arranging protection for the client? Okay, here's the answers. What product would pay out if a client were to have a heart attack? That's the critical illness policy. Name 2 products that pay out a monthly benefit: income protection and family income benefit. Next question was, what kind of life policy would be best for a repayment mortgage? That's a decreasing term policy. And then name a kind of policy that would be suitable for inheritance tax planning or a funeral plan, and that'd be a whole of life policy. What feature can be added to an income protection policy to combat inflation? RPI indexation. A family income benefit is what kind of term policy? That's decreasing. Which feature means a life policy will pay out before death? Terminal illness. If a client has a single life and critical illness policy and they claim on the critical illness, what happens to the policy? The policy finishes. They don't keep the life policy for later on. Again, that's something we can talk about in recommendations. How much will a life policy pay out if a client dies 7 days after the policy finishes? Nothing at all, because the policy's finished. And what is the main advantage of arranging protection for the client? I've put whatever. It really is whatever it is that you feel is the main advantage. For some people, it's sleeping at night knowing that their clients are protected and if anything happens to them, they've done the job properly. For other people, it means that they can earn more money. to be honest, whichever one of those is, it does the other one as well. If you do a really good job of protecting your client, you're going to earn a good amount of money. And likewise, if you're solely driven by money, as a result, you're going to have a whole load of clients that are protected really well. Hopefully they just give you a flavour of the content of the course. And as I say, if there's any there you really struggle with the answers, then maybe the thing to do is to get back in contact with someone at TMA or myself, and we can go into a little bit more detail. That pretty much concludes today's session. Just wanted to throw a couple of email addresses, customer services at tmaclub.com. We'll be able to help you with inquiries. There's also a callback form on our website at the moment, rather than phone calls where we've got with the COVID-19. There's a hub on the website as well, which gives you news of what's going on. And there are, say, live events like this being run constantly throughout the next weeks and months as we go through the period we're in. Just look out for either on the website or the emails to see what you get. Remember, you get CPD for these, and we have a customer retention kit. KIT stands for keeping in touch, on our website, which just gives you some really useful information. Thank you for your time. Hopefully that's been helpful to you. As I say, if there's anything else that you need, just let us know, and we will hopefully be able to help you. Many thanks.